All right, everyone. Thanks for coming out. We really appreciate you coming in late evening during the week and during the rain, and I know it's been incessant. So we really appreciate your attendance, and we believe that this is going to be beneficial for all of you. And it's great information. It's pertinent to everyone, whether you're a young professional, a lawyer, anything. So whatever group you're here with, it will all be applicable. And we just want to say thank you for coming. My name is Michelle Thompson. I'm a recovering attorney. I'm no longer practicing, thankfully. I'm with Atlanta Financial, one of the wealth management and financial planning firms here in town. And we'll serve as a moderator. This is for you guys, and so if there's any questions during the time that we're speaking or looking at, we have a few slides. They're also in your notebook. If for some reason this is blurry, I'm bad at IT, so I'll just preface that by saying, if you can't see it up here, it's in a packet, and we'll refer to the slide number. But seriously, just jump in if you have any questions. That's what we're here for, is to help you guys get answers to questions that you might have. And then I just wanted to start off with having the panelists, which we're delighted to have. It's really a rock star panel. Introduce themselves, and then we'll kick it off. Go ahead, Shay.
You're first.
Yeah.
Oh, yeah. Are we putting these on?
I think it's the other one. Yeah.
Hey everybody, I'm Jacqueline Shattuck. I'm a certified financial planner, and I wanted to share with you guys just really quickly the reason why I got into financial planning. And so the short story is, I grew up in Northern California with my family on a 1,000-acre ranch.
Oh, wow.
And long story short, the property was sold out from under my family. So simultaneously, my grandfather passed, and my mother received her inheritance early. When she got her inheritance, she decided that she wanted to move, so we moved to Georgia. I came from a single-parent home, 3 children. My mother worked multiple jobs. And when we got to Georgia, we got here, and she had a lot of money. So she enlisted for a financial advisor, and the financial advisor that she worked with just didn't give her good advice, didn't give her comprehensive advice, just kind of took her money and really just put it all in 529 funds, which we'll get into later, and pretty much left her with no ability to pay her bills and things like that. So I decided to research if there was a person out there who knew all of these different facets of financial planning, so how to budget, how to get health care, how to manage investments. And so I came across the Certified Financial Planner designation, and I decided that was what I was going to do. So that's why I became a financial planner.
Wow, great story.
Yeah. Thank you. Hello, everyone. My name is Siobhan Roman. I guess I should this so I'm not holding it.
Yeah, I think you guys are sharing
Does that
it.
work? All right.
Yeah.
My name is Siobhan Roman. I am so excited to be here tonight. I have been in the business about 8 years. I am a financial advisor. And since you told your why, I will share my why. My mother is a postal carrier with the United States Postal Service. She has been a mail carrier for 38 years, working in Miami, walking in the heat, in the rain, delivering mail. My father is a landscaper. He's had a business for 32 years. And when I initially got into the business, I asked them, had anyone ever approached you to talk about your finances? And they both said no. So for me, it really ignited in me a passion to find people who were just like them, who really needed, maybe not help, but better understanding of how to make the best of their financial situation. That's my why.
Yeah.
All right. You need this or you're good?
No, I'm good.
Okay.
Hello, everybody. My name is Mari Batista. I actually have the pleasure of working with Michelle across the street at Atlanta Financial. First and foremost, again, we're so excited that you guys are here. And also, just to kind of preface all this is a very interactive panel, so if you guys have questions, speak up. It makes it so much more fun for all of us, I think, and educational and so on and so forth. So I, too, am a financial planner, certified financial planner. I got into this business because my dad prematurely passed away. I was 10 years old, and it was just my mom and I. We actually were very fortunate to have such a great financial planner who really took care of us. My mom wasn't the greatest with finances, And he really just kind of led us on a great path. So I looked at him and I was like, I want to give back to the community. I want to take care of women. I want to empower people, especially younger people. So that's kind of why I'm here today. So very excited.
Hey everyone, I'm Megan Landris. So I am a certified student loan professional and financial coach. I have a little bit of a niche specializing in helping people with student loans. And I think my why, honestly, I've always kind of been a finance nerd. My first job, I did bookkeeping at a gym. I loved fitness and I guess I liked numbers. And so that's what drove me to want to go study finance in college. Actually, I went to college with Jacqueline. Yep, go Owls. And so, yeah, I did that during college. I wanted to do some internships, get a big girl job. And so I went and worked at a boutique financial planning firm under 2 CFPs and learned the inner workings of personal financial planning. And what I quickly learned when I started prospecting and working with clients of my own is I was attracting folks in my generation, and my generation is strapped with student loan debt. And so I kept growing frustrated because that wasn't an area that I was able to help those folks with. And so I left, went out on my own, did some consulting. I love financial coaching, helping people who may not be in a place where they have investable assets yet, but do carry debt, do carry student loans. And so I started my own practice, did that, started digging deeper into the student loan planning world. I think my why for student loans was I had a client, she was a chiropractor, had her own practice, making good income, but she had $315,000 of federal student loan debt, and she was making half $100,000. She was making maybe $50,000 at the time, and that was the biggest stressor in her life. And so, she didn't want to talk about investing or anything else but her student loan debt. So that's kind of why I dug into it, really grabbed it by the horns. So now I'm specialized in that area, and talk to me about it, I won't stop. So here we go.
Well, I can attest to Megan being a finance nerd. She served as a Gall treasurer for years now.
Yeah.
So that's
my
a
4th
huge
year.
lift. And so I'm always appreciative when I hear you on the call, because it's a lot of work for her to do. So we've got the packet of information before you, and I'm going to show you on the screen, but it's going to be a little clunky because it's a big PDF. But I think it's important to start out sort of looking at savings, where you are, what your income is, and what the percentage that's prescribed in order to hit your retirement goals. And so if you look here, maybe this will be helpful to point out. So the first is your age now, and then across the top is income. So this slide ends at 50, but then the next slide has higher income levels as well. And if you look at it, your age now, and then how much you're making, assuming 0 savings to this point. This is the percentage annually that your household should be saving in order to meet your income needs at retirement. So you can see, obviously, the younger you are, the better you are because of the magic of compounding. The more you save and have time for it to grow, the better suited you'll be. But then folks like me who are in the 50-year range, we better be socking away a lot of cash in order to retire at a reasonable time frame. And this is assuming that it's retirement at 65. So,
well, I already have a question.
Go ahead.
Of course. Sorry. Are you including 401k or?
So this is just baseline. You have 0 in retirement.
Right, but are you, when you say savings, are you including contributing to a 401k,
yes,
stuff like that?
as a percentage of your income.
Okay, gotcha.
That would include any sort of retirement vessel that you have.
Okay.
Yeah.
And again, so we looked at this a little beforehand. I saw these numbers and I was like, oh, okay. But again, this is 0 savings, so don't let this freak you out. This is just, if I started today moving forward, just always have to reiterate that.
Yeah, so.
And number, like what, if you're putting this money away, what are you hoping at 65 to end, like what do you need to retire?
Right, so you're looking at what your income needs are. So let's say you could anticipate that your living expenses today might be akin to what they would be at retirement. So let's say that your living expenses are $100,000 a year now, and then at retirement, if that's what the number is, then you would have to look here and go, okay, I'm this age, and this is the number that I'm looking to have as retirement income. This is a percent that I have to save every year until I hit age 65. So, again, start early. That's the obvious clue right there. So, I know a lot of you, and please feel free if there's topics that you want to discuss. We have sort of a really free-form agenda, but if there's anything that you want us to discuss, that's what we're here for. And I figured Megan, given her position and knowledge in the student loan realm, that she would be an obvious first person to kick off, and just sort of let her talk about tactics and strategies for student loans. And she is actually working with my spouse with student loans, so I know she's very, very helpful. Just want to get a sense of, I know it's come up in the news about loan forgiveness. How do you feel about that? What are the particulars now, and where is it going in the short term, if you have any insight?
Yeah. So, and forgiveness is with federal student loan debt. So if you have federal student loan debt, forgiveness is not just for folks who work in public service, although that's the shortest time frame, and that's the most talked about thing right now, especially. But so public service loan forgiveness is a 10-year repayment plan, really 120 payments. If you work for a nonprofit or public service entity, you have to make qualifying payments for that time frame, or 120 payments. If you never missed a year of service, never missed a payment, that does equate to 10 years. Whatever balance is left over is then forgiven. That has been something that Trump is attacking right now. He wants to pull the ripcord on that plan. Our assumptions and our thinking process in the student loan planning world is public service loan forgiveness is not going away. We feel things are moving in the direction of getting more favorable for borrowers, and that has historically what's happened. If we look back at just the income-driven plans available in general and the options available in general, 1998 was the first time we ever saw an income-driven plan. It was ICR, the oldest plan on the block, 20% of discretionary income. And they said, we lobbied and lobbied around that time and said, hey, 20% of our income is still a lot. And so they came out with IBR in 2009. So income-based repayment, that was 15% of discretionary income. So that's also when, around the time, 2007 was when PSLF came about. IBR had forgiveness opportunity as well after 25 years of repayment, which sounds like a long time, but we could talk more about that in a little bit. Then we lobbied and lobbied and lobbied and said, hey, we need something better than 15%. Then they came out with PAYE, P-A-Y-E, and repay during the Obama term. And so those are based on 10% of discretionary income. PAYE has a 20-year forgiveness threshold for any type of work, not public service, but any type of work. So we think things are going to trend more in that direction still, especially at where we're at right now in our student loan situation. We feel if things were to negatively impact borrowers, or if plans were to be withdrawn or changed, it would be effective for folks going into repayment at a certain time in the future. So people who, if I were worried, which I'm not worried for things changing, but if I were, I'd be more worried for high school students right now who don't have loans, who aren't in school, who haven't committed or signed a promissory note. And so, if things were to change, we do feel things would be grandfathered in as they are to the folks who are current and in good standing on whatever plan that they are on. So I think that's kind of, if anyone has any specific questions. Yeah.
Wait a minute. I'm a little frustrated.
Yeah.
Now I'm saying, I pay off $1,000 a month for student loans, right? Mm-hmm. And my issue is the interest rate. The interest rate is like 7%. So I'm like, that is higher than what I'm paying on my mortgage. Mm-hmm. So I was kind of arguing back and forth because I'm like, why is it that high? Mm-hmm. And it was like back early 2000s, so I'm trying to understand will there be programs, or is there something to lower the interest rate? Because I don't mind making a payment. It's that if you have a high interest rate like that, I mean, it's going to be for forever paying it off.
Are they federal loans or private? Okay. So federal, my rule of thumb is if your balance is at or below your annual income and your interest rate, you're not anywhere near forgiveness or leveraging, anything like that, then refinancing is a good move. Refinancing
to a private.
Yeah, privatizing.
Okay. So taking federal private.
Yeah, taking your federal loans out of the federal system and privatizing them, because right now, on average, refinancing is at about 5% or lower if you have great credit. And I say the rule of thumb is below your annual income is typically, there are things you walk away from in the federal system. You walk away from the leverage or the flexibility of having an income-driven payment because it's proportionate to your income. If you refinance a balance 3 times your income, your payment is going to be horrendous and it's going to hurt every month. So you need to rely on those income-driven plans a lot of times. But if it's below your annual income and you feel very confident in whatever term you choose, because you can choose your term too, anywhere between 2 years to 25 years. You can choose your term, commit to that, that's your monthly payment, and ideally the goal is to reduce your interest rate. So if that's something you want to consider, you can shop rates, you can do soft inquiries to see what you might get approved for, and play around with a 10-year or a 5-year to see what the payment would be, and then commit to what you feel comfortable with.
So Megan, can you talk to those of us who, when filing taxes with the marital status, and you have to consider, how to file and what impact that has if you're filing jointly versus individually?
Yeah, so with federal loans are so weird. They factor in marital status and tax filing status if you're on an income-driven plan. So if you are on an income-driven plan, your spouse does not have student loan debt. Depending on what repayment plan you're on, regardless, if you file joint, your payment is going to factor in your spouse's income. And so if your spouse isn't helping you foot the bill for your student loans, then your payment is going to probably double if your spouse makes about the same as you. And so filing separately could be a strategy. Yes, there could be tax consequences to filing separately, but they could outweigh the negative consequences of your payment doubling or tripling with that additional spouse's income. So filing separately is sometimes a strategy to leverage.
Good. Lastly, do you have any tips on balancing? I know we're talking about saving for retirement, but when you've got this huge debt load to carry, how do you balance savings versus paying off student loans?
Yeah, so again, going back to rules of thumb, if your balance is greater than your annual income, much greater in a lot of cases, then you're going to need to rely on those forgiveness options. And what I mean by that is we have to keep in mind that student loan debt is not an asset-backed debt. Meaning you can spend 10, 15, 20 years accelerating your mortgage or paying down your car faster to reduce the interest cost over time. At the end of that time frame, though, you have equity within something or you have something to turn around and sell. You cannot sell your degree. So, even if you wish you could.
Right. Are there any takers?
So, with that in mind, we have to make sure that we're not, people get this blinder effect where they only want to focus on their student loan debt. And so you have to, one, if you're going the forgiveness route, your mentality should be, let's pay as little as possible to maximize how much is getting forgiven. There is a taxable consequence for the forgiven debt in the future, potentially. That could be something that is changed. So saving for that over 20 years, though, is definitely doable. But what the goal there is to minimize your payment as much as possible so you can prioritize other financial obligations. If you're going that route, it's full force. Pay as little to the Fed system because essentially it's a black hole. You will never see that money again. And maximize any extra cash flow you have to pay down higher interest debt, to save, establish that emergency fund, and to start saving for retirement. Because you will see that money again. You're not going to see money you throw into the Fed system again. If your balance is below your annual income and the goal is to pay it off before that forgiveness timeline, then reducing your interest rate is really important. Refinancing, I would recommend looking at it annually. You can refinance as many times as you want. You just have to use different companies because they won't discount themselves. And then if you get your interest rate below, 5%, 4%, you can start to play the interest rate game. If you have higher interest credit card debt, that's a showstopper in a plan. Throw every extra dollar towards that credit card debt. If everything else is taken care of, your emergency fund is established, you're ready to invest, but you still have student loan debt, take that extra cash flow and start investing, because you're probably going to make much greater than that 4%, than what that 4% debt is charging you, I guess you could say.
Good. Go ahead.
I was wondering, what would you say about if you have multiple student loans? Undergrad, but you have in law school, but you have separate ones. Would you say it's smarter to pay this lump sum payment that goes to all the loans, or individually pay off student loans?
That's a good question. So in a loan list, no matter if they're private or federal, if you have multiple loans, they all have their own ledger. So your required minimum payment will have to go between those loans proportionately. So for example, if you have 3 loans, they're all $100,000 total. One is $20,000, one is $50,000. For example, 50% of your payment is going to that $50,000 loan, and then 20% of your payment is going to that 20. So once you've done that minimum required payment, then any extra cash flow you can prioritize putting towards higher interest loans or the smallest balance, really however you want to tackle it. Or if you're refinancing, the goal is to get all of those loans simplified, brought together at a lower interest rate across the board. If you consolidate within the federal system, that does it for you, but there's not really a benefit to consolidating in the Fed system other than becoming eligible for certain plans, because it just lumps your interest rates together by weighted average. So it doesn't really lower it. Does that answer your question? Cool.
Yeah, it's sometimes psychologically beneficial to just put one of the loans to bed. So if it's a smaller balance, okay, check, one down, keep going. I mean, it's just sort of boosts your ability to deal with it and makes it psychologically beneficial to just tackle the easiest ones. If you guys are good with student loans,
Did
we'll
you have a question?
Shift gears. Any questions?
No, we'll just keep going.
Okay.
Okay.
Well, we can revert back if you need to. So just to shift gears, obviously this is about financial planning, and a lot of the things that we talk about is retirement, but I don't want to be, you guys are all super young, so it's not that we're focused on that, but it is important that we talk about the vehicles to get you there. And, with the benefit of youth, you'll be able to leverage those tools. And I wanted to ask Jacqueline to just talk about what's a 401k, what's an IRA, all those type of things that you can leverage throughout your career.
Can I get up? I like to get up for this one. Sorry, it's just my personality. I don't want to mess up the camera. And actually, you probably can't hear me. Let me do my best, okay? Because I have a great skit for this that I love to share because people always remember this one. So, when we're talking about the difference between accounts, I know it's going any further.
It's
I'm not
taped.
messing up.
We can hear you.
Okay.
She's worried about the camera.
It's the other.
He can
So-
hear. I think he can hear you.
What I love to do when we talk about different account types is, especially in a room with women, is give you the shopping cart analogy. Okay, so the shopping cart that you're pushing through Publix has an account on the side of it. Let's use a 401k, for example. So you're running through Publix and you're shopping and you have your 401k cart. The things that you're picking up to put inside of your 401k cart on the shelves here, you're picking up a can of mutual funds and you're dropping that into your cart. You're picking up a box of bonds and you're putting that into your cart. You're picking up a stock of Apple and you're putting that into your cart. So you have your 401k cart, and when you put those things inside of your cart and you are going to be taking that money that's going to be pre-tax. So the money that you're using to buy those different things is pre-tax money, meaning that it's taken from your check before you actually get it. So that's your 401k cart. Your IRA cart is very similar, except that your IRA cart is not the one that's attached to your job. So it's not the one from your employer. So that's the one that you, let's just say, set up on your own with Charles Schwab is right down the street, TD Ameritrade, some sort of a custodian would hold your IRA. Any questions so far? Go ahead.
Okay. So I have a 401k. I have had a 401k for a long time. I'm at the point in my life where I make great money, but I don't have no kids, I don't have no house, nothing pays back to me. So I've heard if I get an IRA, that can be like a tax kind of benefit. Is that true? How does that work?
So you run into a few different things when you say you want to have a 401k and an IRA. And that being, you run into what they call an active participation rule, meaning that if you make over, and I don't have my list, but I think it's $65,000, $75,000 a year, you can't participate in your 401k and an IRA. So ideally, if you're trying to put money away for that purpose, for retirement, and you have too much money, you don't know what to do with it,
No.
you don't want to max out your 401k would probably be the best place for you to go.
You said I would want to max.
Yeah, you'd want to max out your 401k.
And then you would want to invest, right?
Yeah, so inside of your 401k,
Come up here, Laura, you got
Maybe
this.
even after you max out your 401k,
Yes.
not to sound, but just
Absolutely.
then you would start investing or paying down your student loans or
sure.
whatever.
Right.
So then you're consulting with Megan. Do I need to pay more of my student loans, or do I need to open up just a brokerage account or an individual account? Do I need to open that up so then I have my 401k cart and I have my brokerage cart, and in both of them I buy different things. Ideally, I have a financial planner who coordinates both of those accounts together for me so that I'm not overlapping. But ideally, yeah. So you would, once you're putting as much into your 401k as you can, then you can look also at building other assets.
Yeah.
Go ahead.
With the 401k, like if you're at one job, does it matter? Like what happens if you switch your job?
That's a very good question. So if you have a 401k at your job and you leave that job and you go to another job, you have a couple options. One, sometimes you can take that 401k and you can roll it into your new job's 401k. So you can ask them if their plan allows for it, because you just got to ask them for their permission. Otherwise, if you don't want to put it into your new job's plan, or your new job doesn't have a plan, you can then open up your IRA basket, and you can take that money from that 401k and you can put it into an IRA.
Yeah, so just to touch on something that you were saying that I think, and to your question, Laura, or point, that a lot of our clients do essentially automated investing monthly. Like you'll see when you're paying yourself in your 401k, it's coming out of your paycheck, and basically you're not really seeing that money because net is what's going into your bank account. Oftentimes you can just set up an automatic withdrawal deposit into your brokerage account, just like a 401k. So it's money just being invested every month. And I mean, really, even if it's a small amount over a year, and then with the growth and all that, I mean, it becomes a lot of money. So any excess that you have that is not being taken up by student loans or retirement, definitely take advantage of that. And as long as it's automated, it's like you really don't miss it, and you don't have to rely on making that deposit every month. So that's one thing to consider.
Without taking up too much more time,
Go.
let me
It's-
go back
please.
and
Yeah, no.
Okay, so I get really excited. All right, so really quickly,
Oh, let me see if, does that pen work okay? There's a couple more.
can you see this? Anybody know what this is?
It looks like a
Table.
It's a milking stool.
Table. I'll take it. Table is a stool. I was thinking bar stool, but if you like milking, but I grew up on a farm. Okay, so this is a stool. Maybe this is my pen. Maybe that's what it is. So this is a stool. Okay, so this is our stool, and in this stool is retirement, right? Or what I like to refer to now, because like Megan said, I'm working with a lot of people that are close to my age. So I work with a lot of millennials and Gen Xers, and I don't even like those categories, but whatever. So this is what you would call your retirement stool, but I'm going to call it work optional. This is your work.
I like that
optional,
stool.
right? Okay. So you get to sit down on this stool at the point when you can retire. And I don't like to use the word retire because a lot of people think 65, Social Security, Medicare, I die, type of thing. So I don't want y'all to think that. I want you to think the work optional period. You know, we have a lot of people who are into the FIRE movement, which is just a retire early. See,
Right.
people who want to retire at like 40, and that's great. So this is your work optional stool. Okay, so these are the legs that hold up your stool. One of them is going to be that IRA, that 401k money. It's categorized the same. You have that. That's holding up your stool. You have your brokerage money. That's holding up your stool. So that individual account that we were talking about, that's another leg. And then this leg was Social Security, but you know,
Yeah.
a lot of us are younger, so
Right.
I kind of say Social Security or the Roth account. So with the Roth account, it's taxed a little bit differently. So basically, when we refer to all of these different baskets with all of these different titles on them, 401k, IRA, Roth, these baskets, it's just, we're playing the shell game with the IRS. That's all we're doing.
Yeah.
Playing the shell game, you know, where are you going to get your tax money from? So when you put that money into that 401k or into the IRA, as we said, that's pre-tax. So you haven't paid taxes on it yet. So when you go to take it out, they're going to want their money, right? That makes sense. So with the Roth, it's the opposite. The money that you put into the Roth is after-tax money. And so when you go to take that out at retirement, it won't be taxable. And so the reason these three are holding up your stool is because, let's say you take the work optional route and you decide to retire at 40. Where are you going to get your money from if all of your money is inside of your 401k or IRA? Well, you can get it from there, but all that money is going to be taxable. So it could possibly shoot you through into a higher tax bracket. So when we're talking about planning, you know, that strategy is not just for people that are close to retirement. You know, as Michelle said, start as early as possible, and so this is a really good strategy to take.
Yeah.
Okay, so my thing is, I've been investing in my 401k for about 15 years now, a little bit older. But my issue is, I don't look at it. It's kind of like you said, take it away and I don't look at it. So every now and again, I look and see what my rate of return is. So what should the rate, because sometimes it's like really, really good, then sometimes it's super, super low. Because I don't go in and readjust it. So what should that rate of return be on your 401k?
So there is no
Yeah.
answer.
I mean,
I'm telling you, the perfect answer for financial planning is it depends.
well, I mean, you're a lawyer, so you know that answer. Yeah, we know that answer too. Yeah, I mean, it depends on how it's invested. Is it aggressive? Is it more, you know, fixed
Yeah.
income? Is it 100% equities? Is it in emerging markets? Is it in blue chips? Like,
I'll
I mean,
add to it a bit. So it's kind of, so we refer to it as your asset allocation. So it's kind of like your secret herbs and spices. So when you get those stocks of Apple, stocks of Microsoft, Amazon, so on and so forth, you also have funds that hold all those stocks for you. So those are obviously going to appreciate. So, you know, we've had a great market. I'm sure y'all have all heard, even with Brexit, even with the coronavirus, the market's still there. Hasn't caught in the cold yet.
right.
Knock on wood.
Knock.
So it really depends on your secret herbs and spices again. So if you have 90% stocks or a mixture of that, that's going to get higher return than bonds. So bonds are kind of like cash. It's going to return certain interest. So there's no magic number. So it's kind of depending on what you're invested in.
Yeah.
But that's where you all would come in.
Exactly. That's why you call your financial advisor.
Yeah. Yeah. And take a look at it and just see what your asset allocation is.
1 second before you, sorry, on that, make sure that you are looking at your account at least annually. At least annually, go into your 401k,
Yeah.
check on things. Don't wait
Yeah,
forever.
don't, yeah.
Yeah.
Yeah, because that's a lot of money. In 15 years, I know it's a lot of money. And so just, it's not that much fun to look at, but definitely keep your eye on that ball, because that's going to be an important leg to the stool for sure.
What are you looking for when you look? I mean, I look at
I mean,
mine,
you're
but I'm
looking
kinda
at it, like,
oh,
I mean, I think it's important to look at everything, whether it's the return, look at how it's invested. Are there other options that are doing better than how you're currently invested? What are the fees?
Make sure you have a beneficiary.
Yeah.
on here.
Yes. You would be
Well,
amazed.
yeah.
How many lawyers, how many lawyers don't beneficiary their account? So yes. Great. Thank you for saying that.
So I wanted to ask with the 401k, so once you retire and you have your 401k, and you're gonna start cashing out some of that money to enjoy your life, how is it taxed at that point? I have two questions about it. So then how
Yes.
is,
So it's taxed when you start to withdraw money from it.
So
And-
can I just,
Yeah, go ahead.
real quick, let's talk about, because some folks with 401ks, and not to get too deep into the weeds, but some folks do have Roth options for their 401k, and then some people just have a traditional 401k. Likewise, with IRAs, you have the option of a traditional and a Roth. And we've got a demonstrative here, and I'll ask Mari to talk about it. But, I mean, honestly, it's, do you want to pay the tax man now, or do you want to pay the tax man in retirement? And that's really,
what rate is it taxed?
it depends on your ordinary
get to that
income
part.
rate right now. But let me
Do you wanna pull up
show
that
this
slide?
graphic, and hopefully it'll help clarify some of it about when to do it and your income level and all that kind of stuff. So,
Exactly. And so, first of all, Jacqueline, that was a wonderful intro, and this is gonna
Yeah,
be you and
hop
I, girl.
in.
So we
Yeah,
got it. We got
tackle
it.
it, y'all.
I'm not really
'Cause
gonna
this is
draw because I'm not
complicated.
that
I'm
like.
getting excited.
yeah, no, I'm glad.
I love it. I love it.
Yes.
So yes, exactly to Michelle's point, there's the traditional side of your 401k and your IRA, the Roth side. As Jacqueline mentioned, the traditional side, you're putting that money in either from your paycheck, so it's coming before taxes, or with the IRA side, you're actually going to get a deduction on that. So again, you're getting taxes kind of taken back from you. So the IRS is going to come knocking at some point because you haven't paid tax on this. It's growing tax deferred, so if you're selling stuff between your accounts, it's not going to be taxed in that shell. But when you take from a traditional or your 401k, the minute you take it out of the account, it's taxed as your ordinary income. So let's say you're retired, yes. So that's why these tools, and this is actually a great graphic. The best thing about retirement plan is you know your income is going to stop at some point, but you are actually going to have income. So that's from your traditional pre-tax IRA, that's from your pre-tax 401k. And so there's various thresholds, and again, I hate to say this, but it depends on where you are in your compensation and your retirement structure and your Social Security. It's a big
Age,
puzzle piece.
all that.
Yes.
And I mean, to some degree, you're trying to predict the future. Like, is your ordinary income rate going to be more or less today than it is at 65 or 70 or 72, whatever the number is? So it's, you know, to some degree, you're having to forecast into the future. But it's something that should certainly be considered.
Yes. But then enter in, which I think is one of two of the sexiest planning techniques, the Roth IRA. There's some income limits to be able to defer into a Roth. But exactly to Jacqueline's point, it's after tax. And also, so even your employer Roth 401k, you'll be taxed on the money and then it will go into your Roth. So since you've already been taxed on it, it'll grow again tax deferred. If you're trading in and out of securities, you're not going to get that tax when you sell something, get a gain on it. And so, since it's already been taxed, when you take it out, tax-free.
Yeah.
So again, to Michelle's point, no crystal ball with where you're really going to be in your tax bracket at retirement. But that's why we kind of like this bucket approach or stool approach,
Yeah.
exactly. I really do
Yeah.
like that one.
Yeah.
Work optional stool. That's why you kind of have that mixture of buckets. So let's say 1 year, your income is low, your Social Security benefits is that you're not taking out of your IRA yet. You can take pre-tax money because that will be income to you, but you'll be in such a low bracket that it's really not going to affect you. Then let's say 5 years later, you're like, oh no, so I have this housing project, so I need to take out of my IRA, my pre-tax IRA. I have required minimum distributions starting at 72. So I have to now take out every year from my pre-tax. That's where that Roth bucket comes in. So does that kind of clarify for you?
Yeah.
I have a couple of questions.
Yes.
Two questions. First, I think I know, but I'd like to confirm the income limits for Roth IRA.
That was my question.
And then the second one, follow-up, maybe not quite follow-up, but when we're talking about our ordinary taxable income, say after 72, is that determined based on, traditionally at least, your Social Security, your required minimum distributions, and then whatever other income you might
Pension,
have?
annuities.
Right,
Yeah.
anything like
That's
that.
in that
That's what
bucket.
so theoretically, for many people, your ordinary taxable
Yeah.
income would be much higher at a younger age than an older age.
Yes, in
In
theory.
theory.
In
Yeah.
theory.
Okay.
Yeah, and like just personally, like I sort of split. I have with my employer, I have that Roth option as well. And so with each contribution, some goes into pre-tax and then some goes into a Roth contribution. So that I will always have a bucket that I've already paid taxes on that I can access, you know, so. And there's a number of tools, you know, if you get on the Google machine and look at whether you should be doing Roth contributions or traditional 401k or something in between, you can do that based on, you know, your age, income level, things like that, and see what might best suit your needs. Go ahead.
So,
Sorry, I have one more quick question.
Yeah,
hold on,
please.
I don't think we just
Yeah, about
Yeah.
the age limits for the Roth.
So,
Income limits?
no,
Yeah.
no income limits. No age limit. So for the Roth IRA, they call it a phase-out range, but it depends on if you're single or
Right.
married, filing.
About to be.
jointly. So,
Yep.
Yay.
Yes.
Congratulations.
well, you and your spouse, it's 196,000 is where the phase-out starts. So,
I will say though, if you file separately, you cannot contribute to a Roth.
Yeah.
You can maybe do a backdoor conversion, but you can't contribute if you file separately. So keep that in mind for the student loan strategy.
Yeah.
but single, any single ladies? 124,000.
Yeah.
And you can literally Google that. The IRS will come out with different limits kind of every
Yeah.
year. So
Which is why I brought
Evolving.
2020 with
Yep,
me.
well done.
yes, girl.
Because I only remember
Thank you.
2019.
Yeah, yeah.
One more thing that I did want to add, the reason why we have the different legs here is because if you try to take money out of your IRA or your 401k before you're 59 and a half, you pay a penalty, unless it's some
Like
sort
Kevin.
of exception. But
Yeah.
for the most part, if you were to try to take that money out because you got to your work optional point, you would pay that ordinary income
Yeah.
rate, so, 28% plus 10% on that money you pulled out.
Yeah.
So that's the reason why I was doing that.
I have a,
What are
Yeah.
the exceptions? That was gonna be my next question is, for some reason I had it in my head that, so my daughter is in college and my husband at one point said, well, we can take some money if we need to out of our 401k without
Yeah.
a penalty, like one time to help with tuition.
Yeah.
You can, as
Uh-huh.
long as it
Saying-
goes directly to tuition.
Yeah, it has to-
You're not penalized the
Is it
10%.
just one time or like per every time I have to pay that thing?
Per every qualifying education expense. So as long as it goes straight to tuition, it's qualifying. But you will avoid the 10% penalty, but you'll still be taxed on the income that's taken out because it's considered income. Yeah.
And did you have a question? Oh, you're fine. You're fine. Let us know if you think of it. Yes.
Sorry. It's my understanding, I was speaking with someone the other day, it's my understanding that I can open an account now, and before it was like the middle of April or end of April or something, I can contribute for last year to
Yep.
a Roth.
Yeah.
Is that
Yes.
correct?
yeah.
Okay.
Exactly.
And it's a max of
6,000
per year, is
Yeah.
that,
until you're 50, and then it's an extra 1,000, so it's 7,000 total.
okay.
You have to intentionally contribute to the last tax year.
Can I do that in one bulk?
Yep.
Yeah.
Okay.
Up until April 15th.
Yes.
April 15th?
Yeah.
Yep.
Yeah, yeah.
Or you file your tax.
Oh.
Right.
You
I
can
don't think
still
it-
amend. You can amend up until
Oh, I don't want
4/15.
I have to do it before I file my taxes.
Yeah.
Okay.
Oh, really? I thought you
Can you do it through extension in October?
I don't think with the Roth one,
I don't think so.
I was gonna file my taxes earlier than that, so thank you.
Yeah.
get back with us?
Yeah.
We'll
Yeah.
check it.
Deposit
Let
that
us know.
first. Yeah.
I'll just wait.
So one of the things that we were talking about, and I want Siobhan to address, especially like to your question, and I think it's an important conversation. We have this with all of our clients, and just looking at your life stage, your age, what your financial goals are, and things like that. But I just wanted to get Siobhan to talk about sort of how younger people are situated versus people who are at the cusp of retirement or in retirement, and see if that prompts any questions.
Yeah, so I noticed that you had this little things to do board. So if I were you, I'd write number 1, insurance. Insurance is not sexy to talk about, but it is definitely one of the areas that I see people waste the most money, and also the area where I see that they really don't understand the coverages and sometimes are underinsured. So here are my tips, and we're going to get to that part
Okay,
too.
good.
If you have house insurance, renter's insurance, make sure that you have replacement cost on your policy. So a lot of
Yes.
times when we call these 1-800 numbers or go see our agent, we want the cheapest price, right? I want the cheapest insurance that I can get. But you don't know what they're doing and how they're manipulating some of those coverages to get you that lowest cost. So if your neighbor upstairs, their apartment floods and now your entire apartment is damaged, your TV is damaged, and you go and file your claim, for your $500 TV, they're gonna give you $40 for if you don't have replacement costs. If you have replacement costs, they're going to give you $500 so that you can purchase a new TV, right? And it costs, it's pennies a day for that coverage. So you wanna make sure on your home or your renters, you have replacement costs. The other,
Same with jewelry too.
yes,
That's so important.
yes, we're gonna talk about jewelry
Yeah.
too.
What diamond you get.
Also for your car insurance, you will be surprised, I don't know if anyone does auto accidents, how many drivers in Atlanta do not have insurance?
Yep.
So check your uninsured motorists. The only person it's protecting usually is you. Like, you don't want to have uninsured motorists of $5,000, $10,000. It could really put you in a difficult situation, and it's really inexpensive.
I'll piggyback on that. Like, I ride a motorcycle, so I have a ton of uninsured motorist coverage.
Yeah.
And
Yeah.
I mean, I didn't really take a look at it until I was talking to my agent, and he was like, yeah, you can't have the minimums. Like, even if you don't ride a motorcycle, he's like, you can't have just the minimums because that's just not gonna cover you.
Right.
So I would definitely take a hard look at
Yeah.
increasing your policies beyond
Yeah.
Georgia's minimum.
Yeah.
And does everybody know what
It's
that
important.
means? Does anybody have questions on what uninsured, the portion of that policy is? Okay.
Free money. All right. Defensive driving certificates classes. I just took one for $19. Find one online, and I saved $220 a year on my policy, which adds up. Now I know my agent hates me because when we sit down, I'm like, "What about this discount? What about this discount?" So I have about $1,800 in discounts, but I understand how these discounts work. Most insurance companies now, especially the larger ones like State Farm, Liberty Mutual, have an app. So you download the app for 90 days, they monitor your driving, and I got an extra $480 for that. Right, so all of those little things really add up, and you have the same amount of coverage, but now you've saved $2,000 a year on it. Questions? All right.
So with
go
that
ahead.
app, what if you drive over and you don't follow? Like,
So the app, they're usually they are looking for excessive speed, so if you're a speeder, don't put the app
Right.
on the phone.
Yeah.
Or don't
Yeah.
connect that drive, that you're driving really fast. But they're looking for your braking, your acceleration. So if you're braking a lot, which is sometimes difficult in Atlanta traffic, I didn't have any problems with it, and I drive from Marietta to the perimeter. They're also looking for nighttime driving between 12 and 4 a.m. So in that 90-day period, I was like Ubering, because they consider that to be higher risk. So those are, and it says all of that in the app, so it will actually grade you every day if you're in first place or second place and how much your discount is with certain carriers. But do
Interesting.
it, call your agent, it's free and nothing but give you a discount. If you drive really bad and you're accelerating and driving in the middle of the night, it won't reverse and increase your premiums.
Okay.
Yeah.
Oh, okay. Well,
And
thank
then
you.
when we think about protection and risk management, the other thing to consider is an umbrella policy. So it is usually the thing that most people don't have. An umbrella policy really acts as an umbrella, so it sits over your homeowners, your renters, or your car insurance. So if you have an accident or a claim against your policy and it's more than what your policy covers, your umbrella policy may be able to pick up those limits. So think about in the state of Georgia, it's easy to get into an accident and it's $70,000, $80,000. Well, if you only have $25,000, where does that difference come from? right? So they're usually going to be looking to get it from you personally. If you have an umbrella policy, the umbrella policy will pay that difference. Mine is $1 million, and it costs a whopping $13 a month. But it is peace of mind. So think about getting into a small fender bender is $50,000 when you think about injuries and all these other things. So renter's insurance, make sure you have replacement costs, understand your discounts, and inquire about an umbrella policy if you can. The other piece of this risk protection is a question. What do you think your biggest asset is? Just give me some.
Yourself.
I like, okay.
Your work capacity.
Good.
Your house.
Yes.
Right. That's true. It's your paycheck.
Yeah.
So if you have your iPhones, Androids, really quickly, pull them out. Open the calculator. Put in your annual salary and multiply that by how many years you anticipate working. So if I'm 30 and I anticipate working till 65, I will multiply my annual number by 35. Probably is in the millions. Think about, we protect our $40,000 cars, our $300,000 homes, and we forget about this huge asset of our paycheck. For me, the ability to get up every single day and go to work is truly my biggest asset and my biggest concern. So what happens if I'm not able to do that? What is my plan B? In my younger days, it was go back home, right? That's not an option anymore. My mother would say that's not an option. So really, you want to think about having income protection, or what's referred to as disability insurance. A lot of times when people think of disability, they think of the most tragic things, right? Someone being in a wheelchair, someone being bound in their home and not being able to go anywhere. If anyone has ever suffered from depression or anxiety or known anyone, those things can really keep you from working, whether it's full-time or part-time. How do you make sure if something happens, you still are able to maintain your lifestyle, right? So the first place you want to look for that disability coverage is going to be your employer. Most employers, especially larger ones, have some type of income protection that they refer to as long-term disability and short-term disability. I buy everything. Short-term disability, give me all you got. Long-term disability, give me all you got. Through your employer, it's usually going to be really inexpensive. But if you are out for an extended period of time, what happens to your 401k contribution that you're making, right? What impact does that have when I retire? How long will they actually give you that benefit? So if is it only a year? Is it 2 years? You really want to make sure that you understand the protections that you have. And if you don't have enough, think about talking with someone to get what really works for you. There are tons of different ways to get these income protection policies, from like the Toyota Corolla version all the way up to like the Maybach version. Like it really is really customized to what you need. But more importantly, make sure you have opted into everything that you can with your employer. Right? The worst feeling is not being able to go to work and calling your employer and you not receiving a paycheck because you didn't check a box, right? For pennies a day. Questions about that?
I have one.
Okay, I'm ready.
The percentages of your annual, I guess, income that are covered by the long-term,
Yes.
short-term disability insurance through your employer, is that your total gross income, or is that your base salary?
It's your gross. Your gross, your normal salary. So not including bonuses,
Right.
commissions.
Okay.
Most are only going to include your regular salary.
Okay.
It's a good question.
And are those benefits taxed?
And they are taxed if your employer is paying for them. If you are paying for them, they are not taxed. So think about an average long-term disability being 50% is what they'll give you. 50% of your base salary. And then you're taxed on that. Not only are you taxed on that 50%, but now I have to pay this $1,100 insurance premium for me and my spouse and my children, right? And I have to pay taxes. I mean, it really can,
There's nothing.
it can leave you with nothing,
Right.
right? With a couple $100s. So really understanding those numbers. I hate paying my disability insurance. It's $122 a month. I hate it.
Yep.
But the peace of mind that it gives me, I would pay $122 a month anytime.
And for those of you who have a bar card in your wallet, State Bar offers
Yeah.
quite good coverage. And then, whatever field you're in, typically there's some sort of advocacy group that you could look at and have options there too. And then, of course, again, just get on the internet and see what options are available. It's basically you have to establish what your income level is and then go from there based on your health history and things like that, age, etc.
So it's usually going to be your paycheck stub or your income taxes and your employer benefits.
Yep.
And that's how most advisors will help you identify what you actually need.
So I have on more than one occasion been denied for disability insurance because of some previous health issues that I've had.
Yeah.
With that being the case, are there any other, I guess, insurance vehicles to have that same type of coverage? I know that there's something called an ACL where you can have a long-term care benefit tied to that.
Yeah.
Is that?
There are definitely hybrid products. I would even inquire about perhaps if you have a pre-existing condition, ask the advisor, will the underwriter consider excluding just that pre-existing
That's
condition?
the only thing that would require me to use disability insurance. More
That's
than
what we
likely,
think.
Unless there's something catastrophic. Well, I know, but.
But I mean, to think about it, I mean, so just get something, right? So if you say,
Yeah.
hey, I want to get this policy, I know if this condition isn't covered, I still will get what I need. But there are definitely hybrid policies that you can take a look at, but usually the underwriting is going to be really similar, right? They're looking for the likelihood of an event happening, and if it's happened in some time frame that the underwriter, whatever that company's risk is, they just won't insure that risk. Yeah.
So, any other questions?
That's a good question.
About disability insurance?
That's a really good
Go
question.
ahead.
Well, I don't know if it's disability or just
Okay.
if it's a different insurance product, but as you think about, like, parents haven't always planned well.
Okay.
You know, I've heard people call this the sandwich generation, where you
Yeah.
may have kids at home, but then your parents
Yeah.
need
Yep.
additional care.
Yeah.
They may have to go to an assisted living facility because you're still working. Are there any products that will help pay those costs associated with parents?
So the solution is called a long-term care policy. Right? Long-term care insurance covers if you need care in an assisted living facility, in a nursing home, having a nurse come into the home for a certain monthly benefit, right? It definitely is not inexpensive, but I tell people it is a lot cheaper than paying it out of pocket when it happens. Usually most people are going to look at something that will cover 2 years, but it's hard to tell these things. We really are guessing, right? I've had relatives who've been sick for a decade, and then some who've passed away in 6 months. So it really depends, and you really work with your advisor to determine that period, but it's called a long-term care policy. And really, it's something to be concerned about, especially when you think about your parents really could burn through all of their assets and then still have to rely on you because they haven't planned appropriately.
And do the people you want to cover you're related to have to sign off on the policy? if
They
it's a
do
long-term?
because they'll have to go through medical underwriting. I have an identical twin sister, and it's just the two of us. So we both pay for my mother and my father their long-term care policy. I think it's $3-something a month. We split it, and our thought simply is we have to go to work every day. Like, I cannot stay home and care for them, so I'm just gonna take the hit and pay the premium.
Wow. You're
That's
a
something
good-
to consider.
A good daughter, for sure.
The other thing is we think about is life insurance.
Yep.
So for parents, I see it. I think it's a really difficult conversation for adults to have with their parents, whether they are 20 or 50. So mine was really difficult. My mother just didn't want to talk about it. No one in my family wanted to talk about it. So one Thanksgiving, I said, okay, everyone's here. There's about 28 people in my family. The conversation simply is I'm Siobhan. If I have to pay to bury you, you will be cremated. Like, I'm not going to get
Right.
a loan. I'm not doing any of that.
Right.
Like the next day, everyone was like, okay, what do we need to do? But sometimes it is a really difficult conversation. The most common mistake that I see people have is they don't understand what they have. Tell me your name.
Antramika.
Antramika?
Antramika, yes.
Antramika. Beautiful name. So they'll say, hey, listen, I don't want to talk about that. I have a policy. It's covered. And I cannot tell you like how many policies I've seen that have lapsed. Well, my mother was in care for 6 months and oh crap, like on the 91st day, her insurance premium lapsed and the insurance company will not pay it, right? So I always tell people, if your parents have something, understand what it is. I just would rather just buy it for them. That's just me.
Yeah, well, I think you had to answer more questions. I was going to piggyback off and say, you know, a lot of employers offer life insurance. They'll be like double your salary or
Yeah.
what have you. Should you have something outside of that?
You absolutely should, and I'll tell you why. Is if you are with an employer, great ones here in Atlanta, Fortune 100 companies, but if you go out because you're sick and you're out for 2 years, you're no longer an employee of that organization. So those benefits don't cover you, right? So when you need it most, you're not able to get it. So for me, life insurance is if anyone would be impacted by your death financially. I've seen spouses have to go back to work the next week because they just do not have the money, right? The other reason to get life insurance is if you are planning for it's a business decision, right? I look at my finances as a business. If I think in the future I'm gonna have children, I'll have a spouse, like I really will need a lot of coverage, but I wanna lock in my age because insurance is based right on your age and your health, I might buy I have a ton of insurance. It's not because I need it today. It's a business decision, right, for the amount that I need in the future.
And I was just gonna figure out that because I got my life insurance policy when I was 25.
Yeah, great.
And I work for a big organization.
Amazing.
And they went through a lot of impacts where they laid people off. So if you got caught up in that, because I've been there for 15 years,
Right.
I ended up securing another
Great
job.
example.
I got another job, so I'm good, but I still know that could happen again. And if I didn't have any life insurance, getting at this age would be super, super expensive. So I'm just glad.
Yes, that's a good example. And benefits change. Maybe not a larger organization, but perhaps a smaller or mid-sized, maybe they decide they don't want to offer it anymore. And maybe you're not insurable. So definitely get something on your own.
And you advise, like, basically preparing for the future. Like, I mean, like you said, right now, you might not have the whole big family, but if you predict that might be the case, lock it in now before any.
So I have 30 times my annual income. That's me, right?
Yeah.
Because I see the impact of not having it, and I also have a different strategy of when I pass away, what I really want to happen, right? Which is probably more than most people. Some people just say, I want to make sure my funeral is covered. Well, a funeral these days could be $20,000, especially if I have to ship you to California or bring you from England because you're on a trip. Like, these are all the things that I've seen happen. And maybe the $7,000 that you have in the bank won't work. So it's really to think about, like, what do I need for the future? If something were to happen today, I just want to be responsible, make sure that I'm covered, and the impact that it would have financially on those around me. I hope that helps.
It does.
That's great
Insure your
information.
children. I think it's like taboo. People are like, I don't want to like profit from my child's death. It's not, to me, that's not what it is. It's being prepared, right? So whether you get it through your employer, you buy a small $10,000, $25,000 policy, if you don't have the cash and something happens, it really could create a really difficult situation.
Well, I'll say, like, I was insured as a kid. Like,
Yeah.
I'm a 90s baby and someone took out a Gerber policy on me.
Yeah.
And now I'm going on 30 and I have that money. So even,
Yeah.
I mean, that's enough to bury me. I have no kids, what have you. So it's like, that's something I don't have to think about. Now, if I want to plan for the future, that's when I start thinking about more. But I think it cost my mom like $2 to do
Yeah.
it back then.
And also understand that some people use life insurance as an advanced planning strategy for retirement, right? There's cash value and there's all these other advanced concepts. So it may not even be just insurance. It may be some other advanced strategy that you may need it for as well.
Anything else? There's several topics that I hope we can get to. I don't know how late everybody wants to hang around, but several things that I think, just as the panel as a whole, to address. Budgeting tools, do you guys have any like electronic budgeting tools that you suggest?
Please.
Yeah, I can go ahead and take this. So budgeting is not fun to anyone, even in this field. Budgeting
Cash flow
sucks.
planning.
Cash flow planning, yes.
That
It's not
sounds
fun.
better.
It can be tedious, but it can be so crucial to your success in retirement, tomorrow even. It's a great just kind of check under the hood. Where am I really spending all my money? There's various tools out there. Depends on how granular you guys are. I feel like lawyers, you probably like to look under the hood a little bit. So, there's various apps. So there's mint.com. So that's basically under the Intuit, so the TurboTax branch. It's a great software if you have multiple accounts, multiple credit cards, debit cards, and so on and so forth. You plug in your information, it will take all of your latest statements. I will say at first, it's one of those that you sit down with a glass of wine and you go through, and it will try and categorize most of it. It'll say, okay, obviously you're a BP at a gas station. So once you kind of, if you keep going to the same restaurant, it says it's a grocery store. It will learn you as you go, and then it will kind of develop the budget with you. So you say, okay, I've been doing this for about a month, and it's like, hey, so you say you're budgeting $20 for gas a month, but really you're doing like $100. I don't know where you guys are going, but so that's a great tool, mint.com. You need a budget. It's YNAB. So it's an app, and it's desktop style.
Did you say Mint was free?
Yes. Yes. You need a budget. That's a little more granular. So what it does is it's called $0 budgeting. So every single dollar that you take in for a month will have a place, and that's where a lot of people find success as well. So if you have a surplus of money at the end, that's when you say, okay, so I'm going to start saving money into my brokerage account. I'm going to start paying down my student loans. Every single dollar has a value. So that's a great one as well. That's a 34-day trial, and then I think it's about $7. It adds it in the budget for you, fun fact. And then if that's not your cup of tea, and it's kind of the same thing, you log in all your accounts, you start to make the rules for your recurring payments and whatnot. Another great one is you just literally can go on Excel, and if you type budget, it will give you an Excel spreadsheet. So if that's something, if you just want to go broad-based, okay, so I spent $1,000 on Amex. That's where that is. I spent $100 on my gas card. That's where that. Rent was $1,500. That's very, very high level, just so you can kind of see, this is what I bring in, this is what I'm spending. And so those are kind of the tools that we start to recommend. And I think with time, you'll start to really get in the notion of, okay, so I got to sit down. Do I want to go more granular and really see if I'm spending more than I'm making? Not ideal. So let's look under the hood. Where can we take out some money? So hopefully that helps.
Jacqueline, did you have any other suggestions?
The only other tool, I don't know if you guys are familiar with this, envelopes.
Oh, great. You have Dave Ramsey?
Yeah, envelopes is the only other one. If you use, I'm not talking about the physical, you're talking about the online one?
I was talking just like
You're talking
Dave Ramsey,
literal
like
envelope.
Yeah, there's literal
Yeah,
cash in an envelope.
You guys might be familiar with that, but I'm not talking about physical envelopes. I'm talking about the online system envelopes.
I haven't tried that.
So it's a similar price point to You Need a Budget, and it does the same thing, aggregation, categorizing, transactions, all of that. But what it does differently is instead of putting it into different categories, it puts it into different envelopes. And if you don't use all of the money in that envelope, it rolls it over into either another category that you'd like. So it's like, okay, this is my budget, and I don't use $50 out of here. It rolls that into my travel fund. It doesn't actually physically move it from your bank, but it says, okay, you have $50 that should be in your travel fund. So you know, okay, I need to go take that extra $50 that I didn't spend and put it into my travel fund. Otherwise, I know I'm not calculating this correctly, and maybe I spent cash that I didn't account for. So it's a little bit of a different system. But I do like that if you're the kind of person who's like, okay, I want to, buy this new fancy thing, but I need to save up for it. So envelopes help with that.
Wow, I haven't heard of that.
I know.
Thank
I'll
you.
have to check that out.
Yeah, I'll be looking at that this evening.
I have a question
Sure.
going back to our conversation about retirement accounts that myself and some friends have gone through. As millennials, we're not at a company for like as many years as maybe like our parents. Like my dad has been with this company for like 20-some years, has a pension, whatever
Right.
that is.
Yeah.
You'll never see that.
Way of the dinosaur.
Now.
Yeah. Forget that.
So, at my previous company, it had a Vanguard, Roth 401. But when you go to a new company, if they give you a retirement account using a different service, I know that sometimes you can't, or you don't transfer it. Is it just that you can only have one of these active that you're contributing to, and you just kind of leave the other ones to sit and grow? I'm not exactly sure like what happens if you're switching jobs and you start to have all these different.
So
Can you take that?
Yeah.
in my case, I believe in simplicity.
Yeah.
So I don't really believe in having like 7 Roth accounts.
Right.
Right.
So for me, I would just try to make it simple and get everything into one place if I could. So if I had multiple Roth 401ks somewhere, I would most likely just open up a Roth account and put all of those 401ks into that one Roth account.
Like your own personal one.
Yeah.
And then what happens to your employer contribution though?
So I was going to say, the only thing is if you have your employer contribution at another place, that account is going to be separate if you're still actively employed there.
Okay.
And then
So at minimum you could have two.
Right.
So you have your active bucket and you have your past employer.
Right,
Yeah.
so you kind of aggregate, and you're allowed to do that. You just can't
Absolutely.
bring your old one to
Some
your new
some
one.
some employers do
can.
allow you
Some
the
you
portability to bring it in.
I will say though, as a financial advisor, we have this conversation a lot with our clients. So what do I do with these buckets? Let's say, I mean, just for a name. So I worked at Keenan Spalding for 5 years. I have my 401k still there. Why would I roll it over?
Right.
So in your 401k, you guys only have a certain amount of options. And generally they'll try and make it a little bit simpler, have 10 to 15 funds. If you move it to your own individual account outside of that, the world is your oyster.
Right.
So you have access to so many. So that's why we kind of say, and exactly to Jacqueline's point, aggregate them, make it easier on yourself. So if the market's starting to fluctuate, you're freaking out, you don't remember your password for your Keenan Spalding, I mean, you can save your funds that way.
I mean, and people literally, I know it's hard to fathom, but they forget that they have these
They really
accounts
do.
floating out
They
there.
really do.
Especially if you're not checking it.
Right. So
But, okay, but I just wanted to confirm that sometimes you can combine and sometimes
Yes.
they won't let you.
it's
Yes.
predicated on the plan, the
Okay.
platform
Okay.
that the plan is on.
They
So
each have their own
I
rules.
just didn't want to be like someone taking advantage of me not being able to do that.
No.
I
No,
know the
exactly.
rules,
Yeah,
so that
and
makes sense.
not every employer permits it, but you can ask your HR representative
Okay.
or the plan provider. They'll be able to tell you. And if not, then you can just take an outside account and aggregate them that way.
just to piggyback on having the flexibility of the different options in the account, that's a good reason, but also you're gonna pay a lot of fees in your 401k. So you wanna check, if you have multiple 401ks out, you wanna check and see what those fees are. Because not only are you restricted by options, but you're also restricted by the fee. So that's
point.
just something to check on.
Yeah, and I mean, if you were to analyze the impact of fees over 25, 30, 35 years, even though on its face it looks small, it adds up. And so you definitely want to check that out. And 401ks have, a knack for slipping fees in.
There's
Yeah.
a research report by Pew, and it says that the average person will pay $124,300 in their entire lifetime in 401k fees.
Yeah.
There's just inside of your 401k,
Yeah.
you're gonna pay a very large sum over your lifetime. So it's just important to go analyze the fees.
You had a question?
But you can't do anything about the fees though, right? I mean, if it's through your employer.
Right.
If you're still actively employed
Exactly.
there, you just kind of
Yeah.
suck it up.
So then I'm kind of like her dad, I got the pension thing. So.
Wow,
you didn't-
congratulations.
you didn't-
Yeah.
Well, I got lucky. I got in 2007, they grandfathered me in. So
Wow.
I started by 2007.
Nice.
I got one.
Yeah, absolutely.
So you didn't talk about that. So like, I do have one, which is probably why I don't look at the 401k now, but I guess I should. What's the tax implication behind that? Like, does it help you? Does it matter? Or?
So a pension is going to act in a different way than 401k. Again, not everybody's going to see a pension. You're very lucky for that sense.
Yeah,
But a
indeed.
pension is basically you're deferring money in pre-tax. What's going to happen is it's going to start pooling, and when you hit retirement, they're going to have an actuary say, okay, so based on your age, some family health history, so on and so forth, we think you're going to live this long, so we're going to pay you a guaranteed lump sum every month, every quarter, whatever the structure is, based on your value at that time, kind of the longevity, just as I mentioned. The taxability on that, though, is kind of a prorated portion, so it's not going to be fully taxable. It depends on the type of pension. There's a qualified and a non-qualified, so I don't want to go too much in the weeds, but that's one of those things that you would want to show a financial advisor, just to make sure that you're optimizing that. But at the same time, you also have the possibility of doing a lump sum rollover. So you've accumulated all these funds throughout the year, kind of like a 401k, and instead of saying, okay, I'm going to turn on that income stream for the rest of my life, I'd rather take that out as a whole sum, put it into an individual account, and that's going to be fully taxable.
But then you have control over it. It's not this required income stream that you have to take, and and also with the lump sum option, if you're offered it, you definitely want to do some analysis or have someone do the analysis to see, based on your family's history for longevity, and predict sort of like, okay, looking at the math and the rate of return on the pension versus what I could get in the market if I were to invest these funds outside of a pension, at what age does it make sense for me to take the lump sum versus continue on with the ongoing stream of income?
Another point to that, I had a client who,
I was going to say 3 minutes.
Okay.
About 3 minutes.
Okay.
I had a client who didn't care about any of that. They didn't care about any of the numbers, none of that. They just cared that they found out that because they were single, when they passed away, the pension just goes goodbye.
You just read my mind.
Yeah, exactly.
Yes.
I'm reading her mind.
Yeah.
The pension just disappears, essentially.
To a pension.
Yeah,
really.
Yeah.
Yes.
Yeah, so she said, I don't care what the payout is, what the difference is between this or that. I'm taking the lump sum because that's money that I put away in there, and I want my kids to be able to get it.
Right, and depending upon the employer and the pension plan and all that stuff, some people have the option to have a spousal benefit. Obviously, if you as a pension beneficiary are alive, then you're getting X amount. But if, say, you were to pass and your spouse was getting the secondary benefit, all around you guys are getting a lesser amount each month because of the spousal benefit. But to your point, Jacqueline, like if you or whomever as a pension beneficiary were to take the income stream, have no subsequent beneficiary option, and you were to pass away, that money's gone. So it's something that you definitely want to put a pencil to. And then there's lots of factors that you are not concrete, but you definitely want to consider them rather than just on its face saying, oh well, this is the best option because that's what I picked 15 years ago. Anything else? Real quick, can I just show, I want to show just a couple slides because I think it's interesting to see, particularly this one. This is over a span of employment. If you were to keep your 401k contributions static, so in this case, the green, you can see that they kept their contributions at 3% over their employment history. They ended up with $487,000. This next person, the blue line, they did an annual increase, but it was only 1%, and then capped it at 10. And they're talking about 10% of your income at that period. So this person did increase it, and they went to 1.5 million over the same period. The Super Sam, it's kind of stupid names, but still. That Super Sam stayed at 10% of their income every year that they were contributing. Obviously, there are caps depending upon your age and all that kind of stuff. However, you can see the impact that has by just incremental steps year over year over year. I mean, that's $1 million difference. And they work the same amount of time, same income level, all that. So, something to consider. You guys, questions, thoughts? Anybody want to?
I would just add to all of this that your beneficiary designations really do matter.
Yes. No, absolutely though, y'all.
And especially,
Add them on your bank accounts.
Yes.
Just like paying attention to everything else, you should pay attention to it.
Yeah. I mean, I have some stories.
Does
about
everyone in here have an FOPA? Financial power
yes.
attorney?
Love you.
No.
There's, sorry. But there's a statutory, there's a statutory form online, like, if nothing else, just get that basic thing.
So, in a financial power of attorney protects you, like, while you're still here. So if something happens to you,
incapacitation.
you're incapacitated, your mom, your sister, whoever can get into those accounts, can make business transactions on your behalf with that piece of paper. unlike a will that protects you once you're gone. Like this is you're here, you just can't do it by yourself. So pick someone you trust, because they can make business transactions on your behalf. It's like having a healthcare power attorney, but it's for your finances.
Honestly.
Well, and the bills are still going to be there even if you are not
when you come
mentally
back
there.
from being incapacitated, they're still going to be there.
And I think, check me, but like we have clients that have college age kids, and once they turn 18 and go away, if something were to happen to them medically, the parents really need an advanced healthcare directive in order to act as their healthcare agent. And then secondarily, if there's any financial transaction that need to happen, they got to have a power of attorney because they're really not a minor anymore. So all those things to consider.
Attorney?
No, I'm paralegal.
Okay. Well, you recommend that per state, right? Financial power of attorney.
Mm-hmm.
So we talked about some people moving. So if you do move,
Different states have different laws. Yes.
I probably won't take on real quick.
No, you're fine.
My husband and I, we refinanced our mortgage, whatever, down to 15 years because the rates were great. But we said we wanted to pay the house off in 5 years. And we could do it if we did
Nice.
some really serious sacrifice. Do you recommend that, or do you think we should be saving? Because we do have 3 kids, one's in college, the other 2 not. What do you recommend on that?
I mean, this is such a
All right, I'm gonna
personal.
go ahead and say it depends.
Yeah.
But who wants to take this?
No.
They can talk about it.
Yeah, I mean, there's so many variables, but I mean, if you looked at just the basic math, is what are you able to get in the market, your return versus what your interest rate is, you're gonna get, I mean, and this doesn't mean it's gonna happen forever, but if you were taking that money and investing it, the return is far higher than your interest
You
rate.
can
I
leverage
bet.
debt. I think historically our thought process around debt was very, very negative. And credit card debt, yes, negative. Get that out of the mix. But debt with very low interest rates, and I think this happened because years ago,
Yes,
like back in Dave Ramsey age, like mortgages
Like our
were
parents.
in double digits.
Yeah.
That is not
Inflation
the case
was
now.
18%.
Correct. And so now we can leverage debt. My favorite words in planning are leverage and efficiency. I say that all the time. I will say those words all the time. But if we can leverage debt that's not charging us a lot of money, 4%, 3% is nothing compared to what we can achieve by investing that long term. And so you do, yes, the mentality of being debt free is great, but the what you provide yourself by socking money away and investing for your future and doing both at the same time, I think is far greater, or can be.
So this is kind of just a quick, if you go to your slide deck, it's 43. So this will kind of show you where your buckets should be as you start to save for retirement. And as you can see, so you are basically talking about number 7, so those payments with very low interest rates. We're in a great interest rate market right now for mortgages, so exactly to your point. That should be low priority. Funding college, especially since it's in the near term for some of your kids, that might be a great idea right now. Just put some in, let's say 529, which is going to earn you a little more money than that's costing you.
I have a question about 529 plans.
Yes.
What can it actually be used for? And does it go away if it's not used for education?
Great question. Great question. So it's basically qualified educational expenses, room and board, tuition. They actually just came out. There was a new, it's called the Secure Act. Can be instigate or push towards student loans. Also, so anything before college up to $10,000 a year. It's really a great tool, and it does have the portability that you're kind of asking about. So if I have a 529 now, I'm 26, I have no kids on the horizon. Because I'm still paying off my debt. But so essentially I'm putting money in now because let's say my future kids get a scholarship and they don't use it. I can either put that towards their siblings, or I can put that towards my future grandchildren or any immediate family member with no tax consequence. So it really is a great tool to use.
You can change the beneficiary.
Okay, so.
And it doesn't have to just be college. It can be, elementary school, things like that.
Right, so.
Yeah, you can. Great.
Just for a little bit of a backstory, there was an option when I was growing up, my grandparents contributed to my education. Okay. My parents, I was really blessed to start with that. my parents matched what they contributed. I ended up getting a full scholarship to college. So they did not put it in a 529. They ended up putting it in mutual funds at that point in the stock market. And so that, as I went through school, as I grew up, all that grew, and then it financed my divorce. So,
Yay.
I never got it.
I love that.
As long as you're happy, that's
I'm
good.
sure that's what your parents and grandparents intended.
That's the best one I ever made.
Good for you.
But I look at that with my little one. I'm a single mother with a 5-year-old. My daughter is brilliant. If she ends up in a situation where she has a full scholarship to college and I have a 529 that I put all this money into, what is that? I mean, is it better for me to invest it in another vehicle for her that's accessible for a wedding or that's accessible, you know?
I like options and planning. I really like options. So 529s are great if you do feel very confident that that is the direction that you're trying. And who knows that? That's
Right.
Your kid can take the scenic route.
My daughter's really into
Yeah.
school. So my daughter moved to school, and it was the best fit for her, and we gave it our blessing, and we were waiting for our financial package because we were new at all this. And I pay $60,000 a year now for her education because there was no financial package, but we were like, you go to the best school you could get into. Well, maybe that was probably a mistake.
Well,
there's so many kids now that are so smart and they're all going to these great schools and it's becoming so competitive.
Right.
But there's so many options that you
There is
could.
money to put towards the education where you.
Yeah.
Yeah.
I favor options, but
Yeah.
I know advisors might have a different opinion. 529s
No.
are great, but like
Yeah.
actual just brokerage accounts.
Yeah,
are
I
great.
mean-
They can be used for anything.
Yeah.
Anything.
But then, also be aware that like some of our clients have gotten into a situation where they funded UTMA, a uniform trust account for a minor, and then it built up to say $250,000, $350,000. And then when they hit the age of majority at 18, windfall, that's their money. So be careful of that too. I mean, it could just be that you put it in an account in your name, and then you've got discretion over it. And you can either, and I'm a big subscriber, and I tell my clients this, like, you can finance college, you can't finance retirement.
Right.
So
You
that
can
keeps
also
you with
test
some
your
options.
Kids too. I have a lot of folks who recommend, a lot of planners who recommend having your kids take out loans to go to school, because most undergraduate loans do not accrue interest while you're in school. Subsidized loans don't. And so have your kids take out student loans to go to school, and then if they graduate, and they graduate based on whatever terms you set, you pay those loans off with that money that you had in that taxable account. And so that's an incentive, because so many people go to college with the best of intentions and don't finish. And they're stuck with student loans, or they're stuck with, not a degree. And, so that could be an incentive to maybe think about.
I like that idea.
One of the planning techniques that I go, just very quickly, one of the planning techniques that I go to is if someone like you is concerned, I don't know if my child's going to go to college or need this money if they go to college. You can do, you would have to sign up for the Georgia plan here. It's the Georgia plan 529. And when you contribute to that, you can get a state tax deduction.
Okay.
So I believe it's $4,000 for a single. So if you were to put $4,000 over the year into that 529 for your daughter, you can do that. You get a tax deduction for it. You're saving for her, but you're not, most likely not overly saving.
Right.
Somebody would have to do the numbers for you. But I mean, if it's not a crunch for you cash flow wise, then you're saving $4,000 for her, and then you can save into a taxable account too. So it's not an either or kind of a situation.
Right.
You can save
can
up to
definitely
the
bifurcate.
deduction and then put the rest into.
Another thought, just last thought on this, just because I'm nerding out on it now in my brain, but 529s, when it comes to the family contribution, when they have to fill out their FAFSA form, 529 accounts with the beneficiary being the student impact their aid more so than your retirement funds or your brokerage account. So that's something to keep in mind too. If you're on the cusp of getting grants or having your child free money, coming from the federal system, a 529 can hurt those chances more than other money.
Yeah. Scholarships can hurt the passage. You get a scholarship and then it ends up penalizing you.
I think making more than $60,000
Yeah.
penalizes you, so.
Anything else, you guys?
Does it make you guys cringe when someone says like, why can't I just spend my money now? Like, I can't take it with me.
Do you know most of our clients say that?
I mean,
Does it depend or
No,
I mean, I have clients that have to beg to spend money.
we really do
Beg.
see the full range. I mean,
People say why.
I mean, I'm like,
yeah.
you've got enough. Go have fun.
I won't be here. No.
I've heard that.
They're not my clients like that.
YOLO.
Right.
YOLO.
Well, that, yeah.
Can't
I
take
mean,
it with you when you're gone.
right.
I actually told my dad
At that
the other
age,
day,
no.
I was like,
You, yeah.
buy new furniture, Dad. Like, what are you doing with your money? It's like, it's for my grandchildren's inheritance. I'm like, you don't even have grandchildren. Like, sometimes it's frustrating.
You don't even I love it. I love it.
Their daily needs or whatever.
Retirement or Italy? Like,
Well, and
Yeah.
that's a generational thing.
Yeah.
I went to Prague and I was like, I could have put it in a Roth, but I'm a financial planner. The one time.
Can I plug this real quick?
Yeah.
Yeah, please. I was ready to buy one of these tonight. So, correct me if I'm wrong, but if you make a $25 donation, it includes this mug.
Yep.
Which is
Listen to
very,
this.
very
There's
nice.
3 of it.
Wait, let's add on to that shameless plug. Power Soup Project is a 501c3.
Yes.
So that is right now.
Okay, and no plug to any of our own, but I'm so serious when we say go see a financial planner. It's so
Yeah.
important.
Yeah.
Just like you see your doctor every year, just like people come see you, brilliant professionals.
Yeah.
That's why we're here. That's what we do every day. So find one that fits your needs and your niche and whatever you need, because that's why we're here. That's what we do.
Mara, so when do you feel like it's right? Like, what if someone thinks like, oh, I don't have enough money, or I'm not there yet, and not to like Darby's a recent college grad. Like, is she ready to come see you?
So the thing is, again, I mean, we have all shapes, size, and colors of the financial world. So I graduated 3 years ago, so I wouldn't come see myself. I would go do this budget for me.
Yeah.
Set my savings plans.
I think,
Exactly.
and then that's why I
Great
love
point.
like the graduated
Yeah.
stages of planning. So like the folks I'm working with, I'm coaching, I'm consulting on budgeting, debt reduction, savings, of course. But I'm not going in and rebalancing their investment account, or I'm not asking them for an investable or a certain amount of investable assets to manage. I'm working with getting the foundation laid. So that's a foundation, or that's a financial coach. That's someone you're starting out with, laying the foundational pieces. After those pieces have been laid, the next step would be to look for a more full-blown comprehensive planner. So a CFP, financial advisor, who will look at your situation completely. If you go to someone who you think is a financial advisor, they position themselves as a financial advisor, but every solution to your problems or every
Right.
solution to your plan is
Where are you going
insurance.
with this?
That's not a comprehensive planner. If every solution to your plan is an investment product that only one company is being recommended, that's just an investment advisor. So you need someone who's comprehensive, that will look at all of the pieces, because sometimes I think in our world, the titles are confused or confusing.
Absolutely.
So
Yeah.
never
So-
hurts to ask too how they're paid. How are you compensated?
And the thing is, just go talk to
Just
somebody.
ask. Just ask.
Yeah. How are you paid?
Yeah, how do I pay you? Because if they tell you that you don't pay them, they're getting paid.
They're getting
somewhere.
paid.
So how are you?
Yeah.
Exactly.
How do you get compensated?
Yeah.
That's not an odd question for us to
No.
hear.
No.
It's real. If you, it's
No, that's,
You ask her the price.
and not
she knows
awkward.
everything
Right, I
else
mean,
you buy.
Yeah.
just ask it.
Exactly.
Exactly.
Yeah.
Yeah. Great
You're the
question.
consumer, ask. Yeah.
Also, shameless plug. Follow me on Instagram. It's my first name and the word plans. I post financial planning stuff on there all the time.
I love her
I'll
posts.
get you guys outside for a picture, and also a group picture for anyone who's not camera shy.
Do you want to do that now?
Sure. Can we all join you guys?
Yeah,
Can we do
come on
like
up.
the
Yeah, yeah.
panel one?